in finance isn't the future. It's already making decisions right now. Welcome to the Insight Source, research-backed breakdowns with sources to verify. We cover finance and economy, science and tech, and mind and body. I'm Nora Reed. Today, AI in finance, how it's used, where it fails, and the risks people miss. Let's dive in. I'm really pleased to be joined by our co-host, Leo Grant. In this episode, he'll translate what actually works for AI in finance in 2026, where the failure modes tend to show up, bias, hallucinations, and model uniformity, and which guardrails teams should set now before the EU AI Act's high-risk obligations start to phase in from August 2026, with further requirements applying from August 2027. Leo, it's great to have you.
Great to be here, Nora. Hello, everyone. And you're right, this is a properly big topic. AI evolved from an interesting future tech to a line item on almost every CFO's budget in record time.
Quite. And it's not just a feeling, there's data behind it. The Bank of England and the FCA survey found 75% of respondent UK financial services firms are already using AI, with another 10% planning to use it over the next 3 years. And the same survey looks at how many separate AI use cases firms are running. Not people using AI once, but distinct deployments across the business. The median respondent expects that number to jump from 9 to 21 over the next 3 years. Today, we're diving into our episode, AI in Finance 2026. We're going to explore how AI isn't just changing finance, it's starting to rebuild parts of it from the ground up, how decisions get shaped, how risk gets measured, and increasingly, how actions get triggered.
Exactly. We'll cover the shift from hype to essential infrastructure. We'll break down the AI investment stack, and then we'll look at what's happening in personalized finance, especially robo-advisors moving from set and forget towards a hybrid and more agentic model.
And we won't dodge the hard questions. We'll tackle the risks, bias, hallucinations, security, and the uncomfortable systemic question, what happens if lots of firms end up using similar models and responding in the same way at the same time?
Good, because the industry conversation is still a bit too product demo and not enough operating reality.
Leo, let's start there. Hype to infrastructure sounds neat, but what does it actually mean inside a bank, a fund, or even a fintech?
It means AI stops being a pilot on the side and becomes a layer in the operating model. Not just a tool you try, but something you design around. Data in, models in the middle, decisions out, and controls wrapping the whole thing. And it also means the spend shifts, not just buying apps, building capabilities, data quality, model operations, monitoring, audit trails, security, and governance.
So when people say AI is like electricity, the boring translation is it becomes assumed. And if it's assumed, it has to be reliable because everything else depends on it.
Definitely. And the BOE FCA survey highlights that firms are using AI across a range of business units. Internal process optimization is one of the major categories, along with cybersecurity and fraud detection. That tells you where the immediate value is being captured.
Right. Less talk to a chatbot, more remove bottlenecks.
Yes, the research is quite candid in the motivation. In many institutions, AI is primarily justified as a productivity lever, efficiency gains, cost reduction, and coping with skill shortages, rather than pure innovation.
Which, frankly, sounds like finance being finance.
Exactly. But there's a second shift that's even more important than cost: pace. AI compresses time. And in finance, time compression changes risk, regulation, and competition simultaneously.
Give us a concrete example.
Regulatory intelligence is a good one. The research describes how financial institutions are deploying generative AI systems, often with retrieval, so they're grounded, to interpret regulatory updates and translate them into internal policies far faster than classic compliance workflows. In one case study cited in the research pack, a regulatory analysis process drops from weeks to hours. That's not nice, that's operational transformation.
But it also sounds like a recipe for scaling mistakes.
Exactly. If a human misreads a rule, it's a limited failure. If a system misreads a rule and pushes the interpretation into workflows, you can scale the error across products, customers, and jurisdictions. That's why infrastructure includes controls, monitoring, audit logs, human oversight, and clear accountability.
And when people ask, why now? It's not just model quality, is it?
It's a bundle of things. This moment is an inflection point because generative models got good enough to handle unstructured language, documents, policies, filings, while tooling like retrieval and fine-tuning became more accessible. That lowers the barrier, so adoption jumps.
And regulation is part of why now, too.
Definitely. The EU AI Act forces planning because high-risk AI comes with strict obligations. And importantly, it's not one single deadline. The high-risk regime is phased in, with key dates in August 2026 and August 2027.
So if you're running a credit model or anything close to that, 2026 becomes get your house in order year. Let's zoom out for 1 second. There's also a market story here. It's not just banks spending, it's an entire ecosystem.
Yes, vendors, cloud providers, consultancies, governance tooling. And the scale is large. According to Markets and Markets, AI and finance might be growing from about $38.36 billion in 2024 to $190.33 billion by 2030, which is an enormous curve.
Which tells you the industry thinks this is structural, not cyclical.
Exactly, but it also creates a risk. If everyone buys from the same small set of model providers or uses similar open source models, you can get concentration risk at a scale.
That leads neatly into the systemic angle we'll come back to later. Let's put a framework on this because it's easy to get lost in buzzwords. You call it the AI investment stack.
Right. 3 layers: application layer, model layer, and the infrastructure layer.
Start at the top, application layer.
That's what people actually touch. Advisor co-pilots, internal research search, AML alert triage, document extraction, customer support assistance, tools attached to workflows, not abstract tech.
And a key point you've made before, if the workflow is wrong, AI just makes you wrong faster.
Precisely. Which is why the best AI wins in 2026 are often the boring ones: data extraction, invoice capture, reporting automation. These tend to be common entry points because the value is measurable and the rollout is relatively low risk. For example, the Vic.ai survey puts adoption at 46% for data extraction, 40% for invoice capture, and 38% for reporting and analytics.
The model layer is next, the brains.
Yes, that includes general models and specialized ones. But what really matters in finance is how you reduce hallucinations and ensure traceability. The key here is retrieval augmented generation, or RAG, so outputs are grounded in reliable sources rather than plausible sounding guesses.
So the model is not making it up, it's writing in natural language based on approved evidence.
Exactly. And then infrastructure is the base: compute, cloud, data pipelines, access controls, monitoring and auditability, plus cybersecurity.
So to summarize, infrastructure provides compute and control, models provide intelligence, applications deliver outcomes.
Definitely. And in 2026, the real competitive advantage is often not the fanciest model, it's the best integration and governance across all those layers.
All right. Next, we need to talk about a part of the market where listeners will actually feel this transformation personally: robo-advisors, hybrid advice, and personalized investing.
Yes, because robo-advisors are where AI stops being abstract and becomes a consumer product with very real consequences for the user.
Robo-advisor 1.0, as most people understand it, was fairly straightforward. You'd fill out a questionnaire, age, income, goals, risk tolerance, and the platform would put you into a model portfolio of low-cost ETFs. It was essentially automation and cost reduction.
Exactly. The early promise was good investing habits at low fees, with periodic rebalancing. Useful, but relatively static.
And Robo-advisor 2.0?
Two shifts. First, hybrid advice. Research on this is very clear. The market isn't moving to 100% robo, it's moving to hybrid systems, an algorithmic core portfolio plus access to a human for major life events, buying a home, tax decisions, retirement drawdown strategy, inheritance, selling a business.
Which makes sense. People want low fees, but they don't want to feel alone when the decision is irreversible.
That's correct. The second shift is what you referenced earlier, systems becoming more agentic, more able to take action within constraints, not just suggesting a rebalance, but executing it under predefined rules.
Let's translate agentic in plain English, because it can sound like marketing.
Fair. Agentic means the system can do tasks that used to require a human click, rebalance, adjust allocations, implement risk limits within a policy that someone has set. Portfolio rebalancing agents operating with parameters like min-max exposure, sector limits, and liquidity checks.
That changes the trust model. If something can act, you need to know what it's allowed to do and what it's not allowed to do.
Precisely. It moves from advice into delegation.
And the upside is obvious. It could be more personalized, more responsive, and frankly less emotional than humans when markets get choppy.
Yes, and research suggests an important behavioral point. AI can help reduce classic investor mistakes like panic selling. But there's also a flip side. If many systems respond to similar signals, you can get a new form of herding behavior.
So AI can reduce individual emotional mistakes while increasing collective synchronization risk.
Exactly. Which brings us neatly to the broader market side, not just retail investing, because the investment landscape in 2026 isn't only better robo-advice, it's also how trading and portfolio construction is changing across the stack.
Let's talk about trading and the investment stack for professionals then. Funds, desks, even serious retail traders. What's actually changing in 2026?
The shift is from AI being niche, used by a few quant shops, to AI becoming embedded across signal generation, risk modeling, and execution. And the big unlock has been AI's ability to process unstructured data at scale.
Meaning not just prices and volumes, but everything around the market.
Definitely. That's where alternative data pipelines get into focus. Satellite imagery, supply chain signals, social sentiment, payments data, and then using AI to translate that into tradable signals. Alternative data isn't new, but the scale and automation are.
So the edge becomes less having the data and more processing and filtering faster, more intelligently.
Precisely. And this has a real implication for retail traders. If you're trading common liquid markets, big indexes, large tech stocks, you're competing with AI-powered signal pipelines. Research on this is candid. Manual trading isn't impossible, but the bar is rising, so a hybrid approach is increasingly sensible. Use AI for screening, backtesting, and idea generation. Use human judgment for risk and execution discipline.
That's an important point, because use AI doesn't mean hand over the keys. It can mean use AI to do the boring parts you're not good at. Research also shows that copy trading is evolving. That's quite popular with retail listeners.
Yes, copy trading is changing from copy trades one-to-one to risk-adjusted copying. Reuters reports platforms use AI to profile both the trader being copied and the follower, and then automatically adjust position sizing and leverage to match the follower's risk tolerance. The aim is to reduce the classic blow-up scenario where a high-leverage trader ruins a conservative follower.
So in theory, it turns copy trading from a lottery into something closer to risk-managed delegation.
In theory, yes, though it still doesn't eliminate market risk or model risk. It just changes the shape of the risk. Let's go back to that phrase you used earlier, assistant to agent. Why is that the most important conceptual shift for 2026? Because it changes accountability and it changes failure modes. If an assistant gives you a bad suggestion, a human may catch it. If an agent is allowed to execute within milliseconds, errors can propagate before anyone realizes. This is a critical frontier for risk management and regulation.
And this isn't science fiction anymore.
No, there are real-world portfolio rebalancing agents that can operate without human approval within predefined constraints. That's already a material change to how portfolio operations can run.
That's why this can't be just a conversation about exciting technology. It has to be about the controls around it and what it does when markets get stressed. Okay, this is the part that tends to make people uncomfortable. If everyone uses similar models, similar vendors, similar signals, what happens?
You get concentration and correlation risks. The Bank of England's Financial Policy Committee has explicitly raised concerns that growing concentration in AI-related services could increase systemic risks, especially if many firms rely on a small number of providers and can't migrate quickly if there's a disruption.
So it's not only, is my model biased, it's, are we all relying on the same few models at the same time?
Exactly. And the Bank of England also highlights the wider stability picture: greater use of AI in core decision-making, increased use in markets, operational reliance on AI service providers, and a changing cyber threat environment.
That's the kind of framing that makes it clear this isn't just a tech topic. It's a financial stability topic, which brings us to the part listeners always ask for, the risks at the human level. Bias, hallucinations, security, and what governance looks like in practice.
Yes, let's do it properly.
Right. We've talked about capability, speed, and scale. Now the question is, where does it break?
In practice, 3 buckets account for most real incidents and near misses: bias, hallucinations, and security. And then there's the system-level risk: crowding and concentration.
Let's take bias first, because that's where AI is objective, goes to die.
Definitely. AI learns patterns from history, and financial history contains discrimination, sometimes direct, sometimes indirect. So models can reproduce unfair outcomes through proxy variables, postcode, education cohort, gaps in employment history, even seemingly neutral behavioral data.
And because it's statistical, it can sound defensible. The model says so.
Yes, and that's the danger. To put it bluntly, if a system is trained on biased historical outcomes, it can scale that bias massively, often behind a veneer of neutral scoring.
So the question becomes, how do you use AI without importing the past into the future?
You do it the hard way. You set fairness constraints, you test for disparate impact, you make models more interpretable where it matters, and you monitor outcomes continuously. We call this fairness engineering, not as PR, but because it becomes regulatorily necessary.
Okay, second bucket, hallucinations.
Hallucinations are when a generative model produces fluent output that isn't true. In finance, that can mean invented prices, imaginary policies, or a confident summary that omits the one clause that changes everything.
And the problem is that it sounds right.
That's correct. Our research highlights key distinctions. LLMs are trained to generate plausible language, not guaranteed facts. So the solution is to ground them. Retrieval augmented generation, restricted knowledge bases, citations, and clear human review for anything high stakes.
So if your finance chatbot can't point to sources, it's not a finance chatbot. It's a liability generator, in my opinion.
That's a fair summary.
Third bucket, security.
This is where the threat model changes. AI can strengthen defenses, pattern detection, anomaly spotting, but it also creates new attack surfaces, prompt injection into internal assistance, data leakage, and data poisoning. There are also risks of deepfakes and manipulated press releases as a growing operational risk, especially for market-moving communication.
Deepfakes are the one that genuinely worries me because markets move so fast, you don't get a comfortable window to verify whether a CEO really said something.
Exactly. A realistic deepfake statement could trigger a price crash before a company can respond. So firms need authentication of official communications, deepfake detection, and incident playbooks that assume misinformation will happen.
Let's pull the camera back, because individual risks are one thing, but systemic risk is where the stakes get much higher.
Precisely. Systemic risk shows up when lots of firms behave similarly, especially under stress.
And this is not purely hypothetical. The Bank of England's Financial Stability in Focus report explicitly warns that growing concentration in the supply of AI-related services could increase risk to the financial system, particularly if many firms rely on a small number of providers and can't migrate quickly in a disruption.
Yes, and because everything is more interconnected, weaknesses can spread faster. So the risk question isn't only whether one model works, it's whether the whole setup stays resilient when something breaks.
Which is a very different question. It's like cloud concentration risk all over again, only now it touches decisions. Okay, given all of this, what does good governance actually look like? Not in slide decks, in reality.
Governance is about ownership, evidence, and constraints. Ownership means one named person or function is accountable for the system in production, what it does, what it's allowed to do, and when it must be shut down. Evidence means you need audit trails, logs, and documentation that explain data provenance, model versions, and decision pathways, so you can investigate incidents and satisfy auditors and regulators. Constraints are necessary for high-impact systems. The AI must operate within clear limits, with escalation paths and human oversight, especially when the system becomes agentic.
And regulation is pushing firms into that discipline, whether they like it or not.
Exactly. The EU AI Act sets strict obligations for high-risk AI systems, including risk assessment and mitigation, high-quality datasets to minimize discriminatory outcomes, logging for traceability, detailed documentation, clear information for deployers, appropriate human oversight, and robustness in cybersecurity.
And the EU's summary is very clear on timing. The high-risk rules don't switch on all at once. They roll out in stages, starting in August 2026, with a further phase in August 2027.
Which means 2025 was the build year. And build doesn't mean you write a policy. It means you operationalize governance, model inventories, risk classification, testing, monitoring, and incident response.
Let's make that practical. If a listener is part of a bank and has some form of decision-making potential, what are the first 3 things they should do this quarter? Quick note, this is general educational information, not legal, financial, or compliance advice.
1. Create a model and use case inventory. If you can't list where AI is used, you can't govern it. 2. Classify use cases by risk and impact, especially anything touching credit, pricing, eligibility, or customer-facing advice. 3. Implement minimum viable controls, logging, monitoring for drift, and a clear escalation path when outputs look wrong.
And for smaller institutions and fintechs?
Same principles, fewer resources. Start with low-risk, high ROI automation. Data extraction, reporting, fraud triage, and be very cautious about anything that makes or executes decisions without review.
Right. Let's go to listener questions. We've got loads, but we'll do a few that represent what people are really thinking. First question is from Sarah in Austin, Texas. As a small business owner, all of this sounds expensive and corporate. How can I start to leverage AI in my finances without a huge budget?
Great question. Start small and boring in a good way. Research shows adoption often begins with practical tasks like data extraction, invoice capture, reporting, cash flow forecasting, and fraud checks, because value is measurable and error tolerance is manageable. For a small business owner, that translates to automate expense categorization, tidy your bookkeeping faster, generate invoice reminders, forecast cash flow, and flag anomalies without handing over final decisions.
And if you're using general AI tools, keep it to bounded tasks. Draft an email, sketch a forecast template, summarize a statement. Just don't trust it with figures. Always cross-check the numbers against your accounting or banking data.
That's correct. Use it for speed, not for truth.
Next question from Mark in Chicago. Will human financial advisors become obsolete by 2030?
I don't think so, but their role changes. AI will take more of the routine, report generation, basic rebalancing, information retrieval, even drafting first versions of client communications. The human value becomes judgment, coaching, ethics, and accountability. And the rise of hybrid robo-advice reinforces that. People still want human help for the decisions that carry long-term consequences and emotional weight.
So it's less about crunchy numbers all day and more about being a guide, helping people make good decisions and stick with the plan when emotions kick in.
Yes, the advisor becomes the pilot. AI is the co-pilot.
Third question, and this is one we got in different forms from loads of listeners. How do I know whether an AI system is assistive or agentic, and why should I care?
Good question. Assistive systems propose, agentic systems act. You should care because once a system can act, rebalance, approve, block, route, your governance requirements jump. You need constraints, monitoring, and an intervention mechanism. And you need clarity on liability when it fails.
Leo, this has been great because it's real world, not hype. You've mapped what's already changing, what's delivering value, and what can go wrong if it's not controlled.
That's the goal. AI in finance is no longer theoretical. It's infrastructure, which means it's powerful, it's everywhere, and it also has to be governed like infrastructure.
And that brings us to the end of this episode of The Insight Source. Thank you so much for listening. If you enjoyed today's discussion, please subscribe wherever you are listening to our podcasts. It genuinely helps. And share this episode with a colleague who's being told to just add AI without a control plan, and everyone generally interested. And if you've got a question for a future episode, email us at letstalkattheinsightsource.com.
I'm Leo.
And I'm Nora. See you next time at The Insight Source.